In today's video, we're going to talk about why real estate, in my opinion, is one of the best inflation hedged investments. If you're new to our channel, my name is Koukun. I'm a real estate investor and I run a real estate team here in the Niagara region. If you're interested in learning more about what we do, check out our beginner's guide to investing in the Niagara region in the comments below. As you've probably heard, interest rates are rising here in Canada, in the US. The central banks are increasing their interest rates, which are causing pretty much all asset prices to come down. And they're doing this in response to inflation. They're trying to combat inflation. They don't want the prices of goods and services to increase at a rapid rate. Right now, I think it's somewhere between 6 and 8%, and that's way above what they're comfortable with, which is closer to 1 to 3%, right? In this environment, all assets right now, in the short term at least, are dramatically being affected in terms of the value of these assets. So bond prices since the beginning of the year in 2022 have come down. Medium to long-term bonds at least have come down double digits, north of 10%. The S&P 500 is down, I think today, close to 25%. Even real estate in the Niagara region, specifically in the last 2-3 months since March, has come down quite significantly. Not on all properties, but definitely on some deals that we're involved in. We've seen negotiated prices as high as 20% less than what that same home would sell for in, say, March. So in the last 2-3 months, we've seen quite a dramatic decrease when there is a seller that needs to sell a property and a buyer that, is willing to buy the property but is adamant about a lower price. In those circumstances, we're seeing some sales happen quite a bit lower than just happened in the last few months. In all this uncertainty, looking forward for the next 6 months, 1 year, 5 years, 10 years, what can you do as an investor, right? And many people wonder, is there such a thing as an inflation hedged investment? Now, Warren Buffett describes the best investment to hold during times of inflation is a business that has pricing power, the ability to increase prices, and its customers will continue to buy its product, and one that doesn't need continual capital investment into that business in order to charge those higher prices, meaning a business that doesn't need to open up a new factory in order to produce more of the stuff it needs to produce in order to then charge those higher prices. So how does that apply to real estate investing? I believe that real estate in a market that is tight, a tight rental market, such as the one in Niagara and in Ontario in general, it does create an environment where real estate owners or landlords have some pricing power during times of inflation. So when inflation happens, we're already seeing it, wages are going up. Employees are demanding higher wages, especially when there's a tight labor market as well. Those wages eventually will find their way into the real estate market. So if there's a shortage of rentals available, people are going to demand higher or be able to charge higher rents. We'll see that in the next few months. In the last 3 years already in the Niagara region, rents are up close to 25%, but relative to Kitchener and Hamilton, those rents are up 40-45%. So in my opinion, there is still some room for rents to grow, but we'll have to see how it plays out. But I do think in the long term, we are going to see significant rental price increases. And the curious part about owning rental properties as an investment, especially if you do it with debt. Now, debt is a double-edged sword. It amplifies your returns when real estate's booming, and it also amplifies your downside when prices come down. You lose a lot more equity than just the amount of the price decrease. That being said, if you have the ability to buy a rental property and hold on to it for the long term, meaning if the price comes down 20% after your purchase, such as what we've maybe seen in the last couple of months, you have the ability to stay put, both psychologically, emotionally, and financially. Just having the wherewithal to just stick to your investment and hold on to it during times of uncertainty, and having cash flow, having the income from your property cover your expenses, and maybe having index fund investments on the side, having cash on the side, just having liquidity, the ability to stay in the game. If you are in that position, what ends up happening for a typical real estate investment is you'll put a 20% down payment and you'll borrow 80% in the form of a mortgage. That debt that you borrow to invest is one of the lowest priced debts you can get, period, for any kind of investment. If you own a business, you go to a bank and apply for a small business loan, the interest rate you're going to get is going to be much higher than a mortgage. If you are even a large corporation issuing bonds, you can see Amazon, you can see some of these larger corporations, some of the debt that they issue, recently we've seen some very low rates when they've issued it in the last little bit, but for the most part, even larger companies issue debt at rates comparable to, and sometimes even higher than, what you and I as individuals can get in a mortgage. Why does this matter? It matters because if you can borrow, for example, on a $500,000 purchase, you're borrowing $400,000 of money that is not yours, that allows you to own this asset that is hopefully going to keep up with inflation in terms of the value of the asset, and the income of that asset is also going to hopefully keep up to inflation, if not go beyond that, while at the same time the debt that you use to purchase that asset, as long as the interest payments are manageable, and obviously with interest rates rising that is a concern, but as long as it's manageable both from the income of that asset in the short term and maybe some excess cash or liquid investments you have on the side that you can use to supplement if there's time periods where rates rise but rents don't necessarily catch up immediately. If you have the ability to stay put during those periods of time, over longer periods of time, what ends up happening is that the value of that debt will lose value year after year after year. So we're hearing things like inflation is somewhere in the 6 to 8% range. Now, people have many opinions on this. Let's use 10% for easy math. If you have a $400,000 debt on a property that is cash flow positive, that you have the ability to stay put and own for long periods of time, 10% of 400,000, 40,000. If that value is being lost in 1 year, that is my definition, at least, of an inflation hedged investment, an investment that grows, and in real estate, exponentially during periods of inflation, which is very hard to do for any investment that doesn't have debt. And most other investments cannot give you the ability to borrow at rates lower than you as an individual can borrow on a mortgage. Even commercial real estate investors who borrow on larger buildings end up typically paying higher interest rates, unless they get to the point where they get CMHC insured mortgages. As an individual investor, I personally think real estate presents an opportunity for one of the best inflation hedged investments over the long term, as long as you have staying power. And right now, it is an uncertain time to buy a rental property. Definitely, as rates are rising, we're seeing the repricing of real estate, which obviously is a scary time to buy. That being said, if you have the ability to have that staying power, whatever property you buy, you're not selling it next year because the prices have come down, right? You're going to hold on to it. So if prices go down, hopefully you still have even more funds to buy another property and dollar cost average through this next period of uncertainty, so that 5-10 years later, when prices are up maybe 50%, 100%, part of it due to the natural increase and natural appreciation of real estate, but also a big part due to inflation just running its course, you will end up significantly ahead during a time when it is going to be hard for most investors to simply keep up to inflation. One of the analogies that Warren Buffett gave was during the 70s, inflation at one point was running around 14%. And he was saying that this was an environment where if you earned 20% return on investment in a company, you could actually lose purchasing power, because after income taxes, which would take the first 6%, you would just barely be breaking even to the purchasing power you had the year before. And in an environment like that, with leveraged real estate, assuming you could continue to cover those interest payments, you end up significantly ahead. Now, again, with leverage, there's definitely risk, and right now we're seeing that definitely in action. So choose the amount of leverage that you feel comfortable with, and maybe it's none at all. But if you are comfortable with having leverage on your real estate investments, having some funds set aside for staying power, I don't see personally for my own investments a better way to get through this time. I do have investments in the stock market through the form of index funds. I don't see that as a way to really build wealth in my life. It is a way to keep up, hopefully, my purchasing power to inflation and to have some growth and to have an investment that is uncorrelated to real estate to a certain degree. But I don't see it as a way to really build wealth in my life long term. So it's something to have on the side, right? I definitely recommend it, but I personally see real estate still as the way to continue to create wealth over the next 5, 10, 20 years. Hope you found that helpful. If you have any questions, feel free to comment below. If you're interested in investing in the Niagara region, definitely get our copy of our free guide to investing in the Niagara region. And until next time, all the best.